Hello and welcome to Money Tips. Look, everybody loves a bargain, right? But not everything you buy that looks cheap is in fact really cheap or really of any good value. Now, many years ago, I used to get a mail shot or a newsletter from a company recommending these sort of penny shares. Do you remember penny shares? And they used to have these lists of penny shares, and they say this guy bought shares for 10 pence, and they went up to £2, giving him a 1,000% return and all this sort of stuff. And you used to look at these things, and then if you subscribe to their newsletter, you would every month you would get a list of penny shares to buy. Now, I never went into those. I mean, a lot of the penny shares that you saw on there were penny shares because, they were very low price and were probably about to fall off the stock market altogether. So, just because they were, cheap on paper, it didn't really mean that, they were really cheap in terms of value. In reality, the price of a share, so if a share is £1 per share, and you think that looks cheap, and then you look at, say, Berkshire Hathaway in America, where the shares are hundreds of thousands of pounds per share, or you look at a company and say, well, that company's shares are, £50, so they must be more expensive than the share of this company that's £5. But that's nonsense, because it depends on how many shares are issued and the overall value of the company. Yeah, you could buy shares for £1 in a company that might only be worth £1 or worth £100. So it all depends on the value of the company and how many shares are issued. And there's ways of researching it. And I suggest that, if you do want to invest in the stock market, you might want to take courses on it, learn about it, or talk to an advisor or whatever. I'm not suggesting you go out and buy shares. So what I'm trying to get at is that just because something looks cheap on paper, it doesn't mean it is cheap and it is good value. Now, my thing is more property. Now, same way if you're buying a property, you could find a property that looks really cheap. I saw a property advertised for £25,000 the other day, but there's a reason for that. Just because you get a property for £25,000 or £50,000, it doesn't mean it's cheap. First of all, is it worth £50,000? It might not be worth £50,000. It might be worth what it is worth. It might be worth £40,000. It might be worth nothing. It might be worth £60,000 or £70,000. We don't know. You need to find the real value of the property, not just the ticket price. Just like I was saying on the shares, you need to do your homework. You need to ascertain whether the property is worth what you're paying for it or what it's advertised for. What's the real value? There's a difference between value and price. The difference between something and the price of something, the value of something, must be looked at. It can be the same, it can be similar, but not always. If you look at the stock market now, a lot of people are saying that the stock market is overpriced, that there's not much value out there. Major investors such as Charlie Munger and those sort of people are not buying anything and haven't bought anything for many years. Not many years, for at least a year or so, even though they're sitting on billions of pounds worth of cash that they could go out and buy anything they like. But they're holding back because they don't think there's value. And obviously, investors want to buy something not just at the face value. They want to find to buy something below value, or at least something that has a good opportunity of going up, with some improvements or with added value. So, generally a property investor doesn't want to just buy something at the market price, right? They're looking for a deal. Now, as I said, everybody loves a bargain, but sometimes we can be sucked into things like penny shares or anything like, let's buy this because it's on sale. Let's go down the shops and, oh, that's on sale. It's always tempting, isn't it? You look in a shop, 50% off. Well, 50% off what? Was it really that price? And I've done it myself. I was out the other day. I was like, oh, they're cheap. They're 50. And I bought a couple of things, but luckily I'm not doing that with thousands of pounds. Not the way I buy shop clothes anyway. So you need to do your homework, obviously. And with property, I think you've got to, the deal is done usually when you buy it, not when you sell it. So you've got to find things that are a real good value and preferably below market value. And this can be for a reason. This could be because sometimes people want to sell properties fast. Sometimes it's a probate sale where the owner has died and the relatives just want to get their money back. Sometimes it can be because there's a problem. There might be a structural problem. There might be a problem with the title or a lease or a very short lease. So, if it looks too cheap, you've got to ask why. If it looks too good to be true, it probably is too good to be true. But there are genuine cases where, something is valued at X, but they're prepared to let it go for Y, which is lower because they just want a quick sale. And this is where all these sort of rescue firms come in. Sometimes it can be because the owner is in financial difficulties and needs to just get rid of a property quickly, and they'll put it in an auction or they'll sell it to somebody who's got cash to buy it. So, look for the real reason, if there are genuine reasons out there as to why that particular asset is cheap. Now, as I said, the stock market's been rising now for 10 years. So this is why, people like Charlie Munger and the Berkshire Hathaway people and a lot of investors are holding back because they realise that, every 10 years or so, if you look back at charts, they go up for a few years and they come down again. And just like the UK economy, usually goes through a recession around every 10 years. And the last downturn was at the last financial crisis, 2007 and 8, 9, that sort of time. So economies go through these cycles, don't they? Things come round and round, boom and bust, highs, lows. And, it's at those times when there's a drop in the market, when confidence is at an all-time low, that, nobody wants to do anything because they think it might drop further. That's the time when you can pick up assets and really find stuff that's below market value. Now you might say, well, market value depends on when, but clearly if you see a share in a major company now and it's £10 a share and there's a stock market correction and it goes down to 5 or 6 or 7, you know that intrinsically nothing's changed in that company. The company's still there, they're still trading, they're still selling what they've been selling for years. It's still got good management, it's got good fundamentals. It's just that the market now said it's worth less because everyone's selling shares. Share prices can drop like a stone because something triggers a market drop, and then a computer program starts selling off shares, and suddenly something that was selling for X amount per share could be 20 or 30% less. And if you've done your homework and you know that company is fundamentally sound, that would be a time to buy it. I'm thinking back of BP Oil when they had that oil spillage. Their shares dropped like a stone, and people were saying, Robert Kiyosaki, I saw him in a seminar, he was live in the seminar in the room saying, BP, they're toast, they're toast, they're not going to survive, and they're BP, are toast, nonsense. They survived, and I'm sure if you look back at their share price then and you look at their share price now, that would have been a time for the brave to go in and buy. It's not always the right thing to do. What if BP did turn out to be toast, as Robert Kiyosaki put it? But, there are just times when the market's dropped and, that that asset is cheap. If you know the prices of property in your area that you work in, and that today they're at X, and, in a couple of years' time, if there's a downturn, they've gone down to that, and you'll know that property all day long is worth more than you can buy it for at that time. So, look at that, think about it, do your research, start thinking about it, get educated, get to know about these things so that you're ready when, the cycle turns around the other way. Now, recessions are pretty scary. People lose their jobs, things tighten up, but they do open up opportunities to acquire assets, real assets, at greatly discounted prices. So there'll be big opportunities there. Now, an asset, you could describe it as talking about Robert Kiyosaki, is something that puts money in your pocket, and a liability is something that takes money out of your pocket. In simple terms, an asset is something you can grow and give you an income and that sort of thing. So definitely it's a time to buy assets, and the rich spend their time buying assets, don't they? They don't tend to go out and get a job and work for their money. They make their money work hard for them. Now, one of the problems in a recession, though, is all right, you've got to learn, you've got to get your ducks in order, find out what you'd like to do if there was a crash. Maybe you need to put some money aside, have some money, and but during these downturns, when I know in the last 2 property crashes ago, I think property prices were at rock bottom prices, but lenders, when prices are at the all-time low, when they're at rock bottom prices, lenders don't want to lend. They lend when they're up there, but when they've gone down to there, oh no, it's too risky. It's crazy. Normally, a property crash comes at about the time when the lenders are piling into it and throwing money at everything, and they're just lending to everybody. Then you know that there's a crash on the way. That's just my guess anyway. But I've seen it happen so many times when things are going crazy. You know that you know, when you go out and buy a property and you get gazumped the same day, and someone else is scrambling to buy it. You know, then you know things are probably due for a bit of a crash. But lenders stop lending, and you know they hold back. So it's very difficult sometimes to get the things you want. So I remember I've witnessed this on a number of occasions. I remember back in the 90s when, you know, the late 80s, early 90s, early 90s was a terrible time. Interest rates were really high, and I knew there was bargains out there. There's properties, you know, in St John's Wood and London, and you could really pick up things cheap, and it was just crazy. And yeah, I couldn't get it. I couldn't buy them because I couldn't get the money. I couldn't get the lenders to lend. I couldn't find joint venture partners, and just, you know, didn't know. I knew people, but I just didn't know how to put it together. And this is something you need to learn how to do, so that if this does happen again, you know, you won't have to rely on mortgage lenders and this sort of thing. You know, the Halifax down the road is, oh no, it's too risky. This is the time when you've got to have your money in place. And had I known, you know, then what I know now, I think, you know, I would have cleaned up. I would have had so many properties because I would know how to get them together. And I think I gave an example in a previous podcast of Jim Slater, who went bankrupt, I think in the 80s, and he bounced back in a few years because he had contacts that could finance him to buy warehouses, old warehouses in Fulham and on the river, and convert those into flats, and he made millions again because he had the mindset to say, right, you know, okay, I'm bankrupt, but I'm not morally bankrupt. I'm not, you know, I might be financially bankrupt, but you know, I've still got that, and you know, I can go out and make this back again. And he had the friends. I mean, right, he had billionaire friends like Sir James Goldsmith, the father of Zach Goldsmith, the politician, who, you know, probably could, you know, bankroll him very easily. And Sir James Goldsmith famously sold everything. He sold all his shares and his properties before the 1987 stock market crash. So he was a billionaire then, and he was, you know, pretty loaded, as they say. However, I wasn't in that position, and I suggest that, you know, you find out how to acquire property with no money down. Now, can this be done? Yes, the answer is you can acquire property. You can control property using a whole range of things without necessarily having, you know, your 25% deposit and a mortgage in place. Because clearly, if you save up 25% and get a buy-to-let property and get a mortgage, you know, it's going to take quite a while before you get another 25% together, isn't it? You know, unless, you know, the prices are going up and up and up very fast, then you can refinance that property, get your money out and move on. It's not that easy though, is it? And especially in a market now where, you know, prices are dropping in many parts of the country and they're barely going up. In places like Scotland, yeah, they're going up, but what, by 3%? And what's 3% of, say, 150,000? It's not a lot, you know. So you can't necessarily pull out vast amounts of money very easily like you can in a rising market. So, and I don't know when you're listening to this. You might be listening to this in July, and there is a no money down seminar coming up on the 27th of July. If you listen to this after then, I'm sure there'll be other seminars and we can get you on. So if you are interested in learning more and really getting to grips with how to acquire assets without necessarily having the money, or how to get into property without having the money, then email me at charles@charleskelly.net, charles@charleskelly.net. That's my domain, and find out how you can, you know, get into this market and open your mind a bit, open your mind to the possibilities out there. Because if I'd have opened my mind the end of the 80s and the early 90s, when there were dirt cheap properties and when there were houses I could buy on the edge of London for £60,000, and there were so many things, and there were properties in London that you could buy for less than 100,000 in very nice parts of posh London, in Westminster. So and I'll never forget this. It's like I can't get over it. But if you've got to know how to do it and how to gather people around you and how to get money to do things without necessarily thinking of the traditional 25% deposit and a mortgage. There's lots of other ways you can acquire, control, and enjoy income from assets without necessarily having the money. So email me if you're interested, charles@charleskelly.net, and prepare to have your mind opened.